What if a law designed to protect you actually made it impossible for you to get credit at all? Imagine a world where your credit cards are suddenly canceled, not because you missed a payment, but because a new rule made you too risky for your bank to keep as a customer. This isn't a hypothetical scare tactic. It's a real economic possibility that could unfold if certain proposals become law. A proposed 10% cap on all credit card interest rates sounds like a fantastic deal for consumers, right? Lower rates mean less debt and less exploitation by big banks. On the surface, it's an easy policy to support. But what if I told you that beneath this well-intentioned idea lies a hidden trap? A trap that economists call a credit desert, which could cut off tens of millions of Americans from the financial system entirely, leaving them with far worse options than they have now. Let's break down the unintended consequences of what seems like a straightforward solution. To understand why a 10% interest rate cap is so dangerous, we first need to understand how credit cards actually work. When a bank gives you a credit card, they are giving you an unsecured loan. Unlike a mortgage on a house or a loan for a car, there's no collateral. If you can't pay your bill, the bank can't just come and take your TV or your furniture to recover their money. They simply have to take the loss. This makes credit card lending inherently risky. Now, banks manage this risk by using interest rates. The rate you get isn't just pulled out of thin air. It is a reflection of how likely the bank thinks you are to pay back what you owe. Someone with a perfect credit score, a stable high income, and a long history of responsible borrowing is a very low risk. They'll get a low interest rate. But someone with a shorter credit history, a lower or less stable income, or a few past mistakes is considered a higher risk. They fall into what the industry calls the subprime or near-prime category. For these borrowers, the higher interest rate isn't just pure profit for the bank. It's what's known as risk pricing. That extra interest helps cover the potential losses from other high-risk borrowers who might default. It is a bit like how car insurance is more expensive for a new driver than for a 40-year-old with a perfect driving record. The higher premium covers the higher statistical risk. So what happens when the government steps in and says, you can't charge more than 10% interest no matter who the borrower is? For the low-risk customer with a 15% APR, their rate drops to 10%. Great for them. The bank can still make a small profit. But what about the subprime borrower with a 25% APR? When their rate is forced down to 10%, the numbers completely fall apart for the bank. Internal models from major financial institutions have shown that if a 10% cap were enacted, somewhere between 82% and 88% of all subprime and near-prime credit card accounts would become unprofitable overnight. The 10% interest simply isn't enough to cover the risk of default associated with these accounts. And when an account is unprofitable, a bank has only one logical move to make. This brings us to the credit desert effect. When a business activity becomes unprofitable, or even illegal, companies don't just absorb the losses out of the goodness of their hearts. They stop doing that activity. In this case, banks would stop lending to anyone they can make a profit on at a 10% interest rate. They would start by canceling the credit cards of their riskiest customers. We're talking about an estimated 47 million Americans who fall into the subprime category. These aren't just numbers on a spreadsheet. These are real people. They are students building credit for the first time, families using a card to smooth out expenses between paychecks, or individuals recovering from a past financial hardship. Suddenly, millions of people who relied on a credit card for emergencies, online purchases, or just managing their daily lives would find themselves completely cut off from the formal credit system. Their primary financial tool would vanish. So, where do they turn? History gives us a very clear and disturbing answer. When formal regulated credit disappears, a shadow economy rushes in to fill the void. The vacuum is filled by payday lenders, auto title lenders, and, in the most extreme cases, illegal loan sharks. These alternatives are far more predatory than any credit card. Instead of a 25% annual percentage rate, these borrowers are now facing APRs that can easily exceed 400%. A simple 2-week payday loan of a few $100s can trap someone in a cycle of debt that's nearly impossible to escape. The very people the 10% cap was designed to help are now pushed into the arms of lenders who operate with far fewer regulations and far more punitive terms. The credit desert isn't empty, it's filled with financial predators. And this is the great, tragic irony of the 10% interest rate cap. The policy is sold as a way to protect the most vulnerable consumers from high interest rates. But in practice, it does the exact opposite. The people who are hurt the most are the very same people the law is meant to protect. Think about it. A middle-class or upper-class borrower with a great credit score will likely keep their card. Their rate might even go down. They are insulated from the negative effects. But the working-class family, the gig economy worker, the young person just starting out, they are the first to have their access to credit severed. The policy creates a two-tiered system where the financially secure get even better terms, and the financially fragile are locked out completely. It effectively pulls up the ladder, making it even harder for people to build credit and achieve financial mobility. A credit card is more than just a piece of plastic. It's a tool. It's a way to build a credit score which is necessary for getting a car loan, renting an apartment, or even getting a mortgage for a home. By taking this tool away, we are inadvertently trapping people in a cycle of financial exclusion. The law that promised to shield them from high costs ends up costing them their access to the entire mainstream financial world, making their situation far more precarious than before. In the end, this isn't a simple story about greedy banks versus struggling consumers. It's a much more complex story about incentives, risk, and unintended consequences. Price controls, whether on gasoline, rent, or interest rates, rarely work the way they're intended. They don't magically eliminate the underlying costs or risks in a market. Instead, they distort the market and push activity into darker, unregulated corners of the economy. A 10% interest rate cap doesn't eliminate the risk of lending to a subprime borrower. It just makes it impossible for a regulated bank to take on that risk profitably. The risk still exists, and someone will step in to service it, but they will do so at a much, much higher price. Before we rush to embrace simple-sounding solutions to complex problems, we have to ask ourselves, who will really pay the price? In this case, the answer is clear. It's the millions of Americans who need access to credit the most. The goal of consumer protection is a noble one, but we must pursue it with policies that are grounded in economic reality, not just good intentions. True solutions empower people with more options, not fewer. Thank you for watching. If you found this breakdown insightful, please consider liking the video and subscribing for more deep dives into the hidden economics of our world. See you next time.